Good morning, everybody, and welcome to NEPC's webinar to cover the results of our 11th annual Plan and Fee Survey. My name is Ross Freeman. I'm a partner and our defined contribution strategist here at NEPC. Joining me today, we have Kevin Kress and Tim Fitzgerald, who are consultants on NEPC's defined contribution team. Today, we'll be covering the results of the survey. We'll also talk a little bit about what we're seeing in the healthcare and higher education segments specifically. This webinar will be recorded, so the recording and slides will be available following the webinar. Please feel free to type in your questions. We plan on speaking for about 30 minutes, and then to the extent that you have questions, we'll answer as many as we can in the time that we have. So let's get started. The defined contribution environment, certainly over the last decade, we've seen any number of lawsuits focused on fees. We've seen fee lawsuits focusing on corporate plans over the last decade, and now in the last couple weeks, we've seen about a dozen large universities targeted with fee lawsuits. In advance of our Plan and Fee Survey earlier this year, we conducted an internet survey to measure plan sponsor sentiment. We gave respondents, or we gave folks 11 different items to choose from to rank. Those items included things like automatic enrollment, re-enrollment, custom target date funds, managed accounts, lifetime income offerings. And not surprisingly, fees were at the top of everybody's list for 2016. And in large part, that's why we do our Plan and Fee Survey. This is the 11th year that we've done it. Our survey is a tool that we use to help our clients understand at a high level what their fees are, and then directionally, we help them begin to understand whether their fees are competitive or not. There's no question that the survey is not a replacement for a formal vendor search process. A record-keeping search is by far the best way to determine if your fees are reasonable. We also, beyond our Plan and Fee Survey, also do a lot of work to help our clients understand whether they have the right share classes available for their programs. So let's turn to the Plan and Fee Survey itself. In this year's survey, we had 117 respondents, 127 billion in assets, 1.4 million participants, and importantly, the respondents were plans across 19 different record keepers. And I think that is important because it shows that it's a very broad survey with plan sponsors across a whole range of record keepers with different products and services available to them. The average plan, 1.1 billion in assets, just over 12,000 participants. The median plan, just under 500 million in assets and around 7,000 participants. Before we turn to the fees specifically, and there's no question that fees get all the headlines, I want to take a few minutes and talk about plan features and investment-related items. In the same way that plan sponsors benchmark their fees to determine if they're reasonable, plan sponsors always spend a lot of time taking a look at their investment menus, their fund offerings to determine if they have the right number and type available to their participants. And if we look at the top left-hand corner of page 4, you can see that the median number of offerings, 22, hasn't changed in the last 5 years. Most plans, 94%, continue to use target date funds as the turnkey solution. 88% use target date funds as the QDIA. About a third of the target date funds are passive, and 10% are custom target date funds. To the extent that the median number of offerings hasn't changed in terms of number, that doesn't necessarily mean that we're not seeing plan sponsors change their investment offerings. If you think about an asset class like TIPS, about 5 to 7 years ago, virtually nobody offered tips within their defined contribution programs, and today it's about a third of plans. So if we look underneath the 22, we can see that in the last couple of years we've been seeing index funds increasing slightly in prevalence. You can see that in our survey this year, 10% of plans added an index fund as a new or replacement offering. The median number of passive options is 3. In last year's survey, it was 2. And approximately 43% of plans have the makings of a passive tier. That means that they have at least 3 offerings that are passive, one of which is fixed income. In the last year or so, there's been a lot of talk, a lot written, that we might see an increase in stable value prevalence. You can see in the chart 47% of plans offer stable value and 15% offer both stable value and money market. And while stable value is the most prevalent short-term offering, we really haven't seen an increase. In fact, those numbers are essentially flat from the last year or two. For those plan sponsors that had prime money markets and they were looking to make a change, far and away the majority just moved to government money markets. They essentially hit the easy button. I think another important observation in this year's survey is the fact that lifetime income, that is in-plan lifetime income offerings, are now available in 5% of the plans. And if we go back 5 years, that number was essentially 0. So I think we're encouraged by the fact that across the broad survey, that plan sponsors, despite the fact that there might be concerns about whether there's an appropriate safe harbor, whether there are issues about portability, transparency fees, the plan sponsors continue to look for ways to help their participants not just during the accumulation phase, but the retirement phase as well. Company stock. Here we are now post the do-not-offer decision. In the last year, we really haven't seen much movement with regard to company stock. For those entities that are publicly traded corporations, 60% offer company stock today. If you're a large plan with 10,000 or more participants, 75% of publicly traded corporations offer stock, and we really haven't seen that change here in the wake of the do-not-offer decision. We have seen a big increase in brokerage windows, certainly over the last decade. Plan sponsors understand that less is more, that if you offer too many fund offerings, that participants can become confused and paralyzed. And so despite any fiduciary concerns that plan sponsors might have, 49% of plans now offer a brokerage window. Interestingly, if we went back 5 to 7 years, we'd see much higher prevalence of full brokerage relative to mutual fund only. It would have been about 70% of the windows being full brokerage, and yet now it's more evenly split, 54 for full brokerage and 46% for mutual fund only. So to the extent that there are some fiduciary concerns and some operational issues as well, many plan sponsors, to the extent that they're making windows available, they're now focusing on the mutual fund only solution. Managed accounts continue to be flat. About a quarter of plans, the plan sponsors in the survey continue to view managed accounts as expensive target date funds, and that's largely because participants don't enter their personal information into the analysis, and so they don't get truly personalized advice, and so with age being the main factor, we essentially have an expensive target date fund. Managed account providers are looking for ways to mechanize the inclusion of data beyond age in the advice solutions, so it's possible that we might see a tick up in the future, and so of course we'll continue to watch managed accounts very closely. So let's turn to fees. As I mentioned earlier, fees get the headlines. There's no question about that. And fees are lower. If we look at the bottom left-hand chart, Weighted average expense ratios down from 46 basis points last year to 42 basis points this year. In our survey last year, just over half of the respondents had moved to a cheaper share class. In this year's survey, 29% moved to a cheaper share class. Sponsors moving to cheaper share classes, slightly higher inclusion of passive investments, these things lead to lower expense ratios. On the right-hand side of the page, you can see that record-keeping fees are lower as well. $64 per participant last year versus this year's survey of $57 per participant. 82% of plans have recontracted their record-keeping fees since 2013. In addition to expense ratios and record-keeping fees, we can also look at total fees, the addition of investment management fees, record-keeping, trust custody, and you can see that year over year, estimated total fees down from 46 basis points to 43 basis points. If we look at the weighted average expense ratio that we mentioned a few minutes ago and the record-keeping fee and compare them to the numbers we saw when we first did our survey back in 2006, you can see that for the weighted average expense ratio, we see 42 basis points versus 57 back in 2006, and the record-keeping fee, $57 per participant today, half of what it was back in 2006, $118 per participant. In addition to measuring levels of fees, we also pay attention to how record-keeping arrangements are contracted. And so I wanted to run through a few definitions just very quickly. We look at record-keeping fees in 4 buckets. Bundled, where fees are covered by a portion of the expense ratio. Fixed dollar, where fees are an explicit fixed dollar fee paid by participant or sponsor. Fixed basis point, an explicit basis point level on assets. And then other, which is a mix of the first 3. And a big observation this year is that the majority of plans in our survey are now contracted on a fixed dollar basis. 51% of the plans in this year's survey are now contracted on a fixed dollar basis. Along with this observation, we also see that revenue sharing is a frequent topic of conversation and whether revenue sharing is appropriate. Certainly revenue sharing has not gone away. 79% of plans still have revenue sharing, but that also means that 21% have no revenue sharing. And when we look at the plans that are contracted on a fixed dollar basis and we look at the plans that have moved away from revenue sharing, it's not just the biggest plans in the survey anymore. You'll see in a minute that it's also small and mid-sized plans as well. If we look at the chart on the right-hand side of this page, we have fixed dollar arrangements. We show assets on the vertical axis and numbers of participants on the horizontal. Not surprisingly, you see that the large plans with 15,000 plus participants and excess of $1 billion in assets, you see a lot of fixed dollar arrangements. But you also now see for plans with less than 10,000 participants, 0 to 500 million in assets, you see quite a few plans that have fixed dollar arrangements. Bundled arrangements far and away now are used by the smallest plans, and you can observe those figures on the left side of the page. To the extent that revenue sharing, or I should say no revenue sharing, is being pursued by large plans, and so it's not surprising to see on the right-hand side of this page that we see a number of plans in the survey greater than $1 billion in assets with no revenue sharing. You can see that there are 16 of them. But maybe more surprising is the fact, maybe not surprising to us, but maybe surprising to the marketplace, is that we're seeing on the left-hand side of the page smaller plans, those with less than 250 million plans that have no revenue sharing. So certainly this chart shows that there are plans both mid, small, large, that have pursued record-keeping solutions with no revenue-sharing arrangements. We have the ability to slice and dice the data in any number of ways, and this is one chart that we show to our clients here at NEPC. We show on the horizontal axis numbers of plan participants, and on the vertical axis you can see weighted average expense ratios. Not surprisingly, you can see that year over year the blue lines are median figures from last year's survey, the green from this year's survey. You can see weighted average expense ratios, 60 basis points median for plans with between 0 and 1,000 participants last year, down to 46 basis points this year. And you can see that there's a downward trend as plans get larger. You can certainly see fees get lower. You can see plans with 15,000 plus participants, weighted average expense ratio, median of 35 basis points. We can look at a similar analysis of record-keeping fees, the per participant record-keeping costs. You can see that for the plans with between 0 and 1,000 participants, the median is down from $127 per participant down to $90 per participant. Fees get lower as plans get larger. For the plans with 15,000 plus participants, you can see a lower fee of $44 per participant, much lower than the $90 we see for plans with between 0 and 1,000 participants. And we can continue the same analysis for total plan cost as well. Not surprising that you see total fees getting lower as plans get larger. You see on this chart, 0 to 1,000 participants, 58 basis points. For plans with 15,000 plus participants, 39 basis points total plan cost, including record keeping, investment management, trust custody, and so forth. I now want to move to Tim Fitzgerald, who's going to talk a little bit about what we're seeing in the healthcare segment of the defined contribution marketplace.
Thank you, Ross. I just wanted to take a few minutes to make some comments specifically, as Ross noted, about healthcare defined contribution programs. As part of our annual plan and fee survey, we've been able to compare data and trends around plan fees and design, specifically for healthcare plan sponsors. This is the 4th year in our survey that we've been able to track that data. So year-over-year comparisons are available if anybody is interested. The healthcare plans in our survey compared to the broader survey, as you can see on this page, have less total assets per plan with an average of $633 million and a slightly higher number of participants on average per plan with 13,175 participants. As Ross noted earlier, NEPC conducted an online governance survey earlier this year to gauge plan sponsor practices and concerns. The healthcare plans exhibited some unique challenges that were different from their corporate peers, and we've highlighted some of those challenges on this page. First, and what was most obvious, is that healthcare plans offered more defined contribution programs, more defined contribution plans in their programs. In fact, 58% of healthcare plans surveyed offered more than one plan, with the average organization having 3 plans compared to only 1 for corporations. And the range of plans that we saw was between 1 and 14 separate plans, so quite a varied range as well. Our study also indicated that healthcare committees tend to be larger than those in the broader survey. 50% of healthcare committees are made up of 7 or more members, compared to only 20% of corporate plans having 7 or more members. These committees within healthcare also tend to take more of a consensus-driven approach in making decisions, which may extend ultimately their overall decision-making process regarding time. And as a result of having more plans, healthcare sponsors also must manage these plans with potentially different rules. We see some of these plans having qualified plans, non-qualified. Some may have a different match component. In fact, some may even have different payroll and processing systems to contend with. Some may even have different record keepers across their program. And all of this leads really to that last bullet on the page, which is strained resources. as a result of having more plans, larger committees, potentially different rules, and dealing with different record keepers. Not surprising to us is that healthcare plans are likely dealing with a significant amount of complexity overall as it relates to their retirement programs. This next slide, you can see as a result of these complexities that we've discussed within healthcare, we show you the fees, and fees both from investment-related and record-keeping tend to be higher for healthcare when we compare those to the broader survey, again, for all those reasons that we just discussed. The weighted average expense ratio for healthcare plans was 50 basis points compared to 42 basis points for the broader survey, as Ross noted earlier. The good news is that healthcare plan sponsors are putting in the work, and that fees, similar to the broader survey, have been trending downward over the last 3 years. On the right side of the page, another observation we thought was interesting and wanted to point out to you, as Ross also noted earlier, that plans within the broader survey experienced that movement towards fixed dollar arrangements. This hasn't been the case for healthcare plan sponsors. Healthcare plans are more likely to be in that bundled relationship that Ross described earlier today, with only 30% of healthcare plans using that fixed dollar arrangement. Now, we certainly are talking more and more about fixed dollar arrangements, but again, only 30% of healthcare plan sponsors are actually moving to that relationship. And lastly, on this next page, we just wanted to highlight a case study where NEPC recently worked with a plan sponsor to address many of these issues that we discussed. This particular program had multiple types of plans, 401k, 403b, they had several non-qualified plans and others, and they were actually across various record keepers. They utilized full-time on-site education, which, as many of you know in the space, is not uncommon. They also utilized guaranteed investment vehicles. Now, all of these components to their program ultimately led to an expensive, inefficient system that was somewhat cumbersome for the participant to navigate. Through an RFP process where we performed a full market review of record-keeping and administrative services, we were able to consolidate the plans and providers. We simplified the investment menu. We were able to reduce the overall cost. And most importantly, we were able to enhance the overall participant experience. At this time now, I'm going to turn it over to Kevin Kress, and Kevin's going to share his thoughts with us on higher education retirement plans.
Thank you, Jim, for your review on the healthcare market segment. I'm going to focus my comments on the higher education market segment, and many on the webinar today may not be familiar with what distinguishes these plans, but there's been increased interest in the segment brought on by more than a dozen class action lawsuits filed in the last 2 months against some universities that you may recognize as listed there at the top of this next page. Certainly each lawsuit is unique, but we wanted to capture for you some of the common themes with the goal of providing some insights on some of the unique plan design features common to higher education plans, and also just to identify any lessons that we may bring out from reading through these lawsuits that other plan sponsors may benefit from knowing about. Certainly the initial review of the lawsuits, there's a familiar tone to many of the corporate defined contribution suits that we've seen for the last really decade plus. We're focused here on investment fees, record-keeping fees, and the appropriateness of plan investments. A deeper dive in lawsuits, and we get at some of the more specific questions raised, which are somewhat unique to the higher education space. First off, the multiple record keeper model. Well, uncommon, I'd say, in the corporate 401k space. It's quite common within higher education, and indeed required for some public university systems to offer the defined contribution program through more than one provider. The benefits of doing so, you might list that the faculty and staff have access to vendors with a wide range of strengths. While one might provide a high-touch type of service with one-on-one meetings, another may have great web-based education tools, and perhaps yet another may promote low-cost index funds or some other strength of that organization. And participants, much like any other defined contribution plan, have the opportunity to move their assets where they see see fit and choose the provider or group of providers that best meets their needs. Perhaps the flip side of that coin being there are incremental costs to administering a multiple vendor defined contribution plan, and there's additional complexities, information sharing on loans, multiple websites, multiple forms, and certainly some of the services that may overlap. One of the other things that's raised in these higher education lawsuits, the appropriateness of annuity investments, which I wanted to comment on. Many higher education plans have been offering fixed annuities for many decades, and these provide a guaranteed minimum rate of return. It's something that we don't see very commonly in the corporate 401k space, but perhaps there's a lesson to be learned in higher education. Has had some great success in providing for guaranteed income solutions to faculty and staff in that segment. Many of these older contracts have guaranteed rates significantly higher than what is available in the current market environment, and the faculty and staff benefit from those guarantees. We would also point out that legislators and regulators have been actively encouraging the adoption of lifetime income solutions and defined contribution plans, really in contrast with what's being alleged in these lawsuits. The other unique characteristic we wanted to point out related to higher education is the often high number of investment choices that are included. 100 to 400 plus investment options is fairly common within the higher education space. Participants have the flexibility, usually across a range of passive and active options, and faculty and staff can invest in whatever specific market niche that they think is most appropriate for their investments. The downside then, of course, of having a large number of investments, you're more likely to have an investment that performs poorly or appears expensive, or both. And really what's going to be evaluated through these processes, what is the process? We have to make crystal clear here from reading through these lawsuits is that everyone needs to think about their fiduciary obligations with selecting and monitoring plan investments, and making sure that the plan fees are reasonable given the range of services provided. The next slide is a case study from the higher education space that I think puts a little bit more color around the unique attributes of higher education plans and some of the things that performing a formal market review and record-keeping search can provide. In this particular case, they had a multi-vendor structure. It was mandated by state law that they offer their program to more than one provider. It did have an elevated number of investment options, as each of the providers had really a full lineup of investment choices. And then there were annuities included, proprietary to one of the providers that could not easily be transferred to another vendor, really creating some stickiness around retaining that particular provider. The problem, as identified here at the bottom left corner with the multi-vendor structure, is that participants find it difficult to see their full retirement picture. Certainly you have the flexibility, but there can be confusion in the enrollment process on who to contact, and as far as the large number of potential investments, getting appropriate information on each. Through this record-keeping search process that we went through with this client, what we identified was a lead administrator, and this is a concept that is certainly grown in popularity within the segment. And the purpose of the lead administrator is to serve as a primary point of contact to simplify the enrollment process and to get primary sources of information for participants, and to bring all the information from the multiple vendors together in terms of assets and fund information into one website. Through this process, the client was able to obtain best pricing for administration. They used their scale of their organization to negotiate fees, improve the participant experience through the lead administrator introduction, and then also make some changes to the investment menu to streamline the investment menu and reduce investment fees. With that, I'm going to turn it back over to Ross.
Thanks, Kevin. So I first want to remind everybody that you have the opportunity to ask questions. You can type them in in the box on the right-hand side of the page. We've received a number of questions, and as I said, we'll try to answer as many of them as we can in the next many minutes here. To the extent that you have additional questions, you can certainly reach out to me, Kevin, and Tim. We've put our email addresses up on the screen. And I also want to remind everybody that this webinar is being recorded, and it will be available after the webinar, so you can go back and review the slides if you want to.